Have you ever wondered why some investors consistently outperform the market while others struggle to achieve satisfactory returns? It's not just about luck or blindly following the latest trends. In his timeless classic, The Intelligent Investor, renowned economist and investor Benjamin Graham introduces a revolutionary approach to investing, understanding the principles of value investing. Graham argues that successful investing is not a game of speculation or gambling, but rather a disciplined process grounded in rationality and analysis. He challenges the notion that the stock market is purely driven by unpredictable emotions, and instead advocates for a methodical and logical approach to evaluating investment opportunities. The Intelligent Investor teaches you how to navigate the complexities of the market, identify undervalued stocks, and build a resilient portfolio. Graham emphasizes the importance of conducting thorough research, assessing the intrinsic value of a company, and having a margin of safety to protect against unforeseen risks. This is the takeaway summary of The Intelligent Investor, written by Benjamin Graham. And welcome to Cash Crush, the channel that simplifies finance without giving you a headache. We've got entertaining and informative videos on personal finance, investing, business, and economics. So sit back and relax. Get ready to crush your financial goals with us here at Cash Crush. Investors versus speculators. Okay, let's talk about investors and speculators. These are words that are often used when people buy and sell things like stocks in the market. But not everyone who trades stocks is actually an investor. Some people just make decisions based on their feelings, which is not the best way to invest. Investors are the ones who study and analyze things carefully before they make a decision. They want to make sure that they will get a good return on their investment and that their money is safe. They look at the value of a company and how it's doing, rather than just looking at the price of the stock. Speculators, on the other hand, are more interested in the short-term movements of the stock price. They buy stocks when the price is going up and hope to sell them to someone else at an even higher price. And when the price goes down, they sell quickly to try to limit their losses. They don't pay as much attention to the actual value of the company. Defensive versus aggressive investor. According to Graham, there are two types of intelligent investors: defensive investors and aggressive investors. Defensive investors are the ones who don't want to spend too much time on investing. They like things to be simple and they don't really enjoy thinking about money or investments too much. Their main goal is to perform average, just like the overall market, and to avoid making big mistakes. They want to play it safe and not take too many risks. On the other hand, aggressive investors are willing to put in a lot of time and effort into researching and selecting stocks. They actually enjoy thinking about money and investments, and they see investing as a kind of competitive game that they want to win. Their goal is to achieve better returns than the passive investors. Both approaches can be smart and successful. The important thing is to choose the right approach that matches your own personality and goals. It's important to stick with your chosen approach for your entire investment journey and to keep your emotions in check. Emotions can sometimes make us do things that are not good for our investments, so it's important to stay calm and make rational decisions. The defensive investor. How should defensive investors invest? A defensive investor should split their investments between stocks and bonds. A good starting point is to have 50% in stocks and 50% in bonds. This way, they can benefit from both the potential gains of stocks and the relative safety of bonds. Sometimes the defensive investor might want to adjust their balance. For example, if they think stocks are too expensive and might go down, they can shift to 25% stocks and 75% bonds. On the other hand, after a big drop in the market when stocks are cheap, they can shift to 75% stocks and 25% bonds. However, Graham suggests not going beyond a 75-25 balance. Why not put all your money into either bonds or stocks? Well, stocks have historically shown higher returns than inflation, which means they can help protect your money from losing value over time. However, stocks can also be more unpredictable and go through big ups and downs. Bonds, on the other hand, tend to be more stable. By having a balance between stocks and bonds, you can be better prepared for different economic conditions. Dollar cost averaging. Imagine you have a lot of money to invest at once. Instead of trying to time the market and invest when the prices are low, Graham recommends using a strategy called dollar cost averaging, which means splitting that money into smaller equal investments over a longer period of time, like every month or every quarter. This way, you don't have to think too much about when is the best time to invest, and you won't get too worried about the market going up or down. By using dollar cost averaging, you can avoid the trap of thinking you can predict what will happen in the market. The truth is, nobody knows for sure what will happen, so it's better to stay focused on your long-term plan. Low-cost index funds. In the past, Graham advised choosing specific individual bonds and stocks. However, nowadays there are low-cost index funds available, which are baskets of many different assets like stocks and bonds. Graham later recommended that most everyday investors should consider using index funds instead of picking individual stocks. These funds provide diversification, which means spreading your investments across different types of assets. Choosing individual stocks. Now let's dive into the part about choosing individual stocks if you decide to take that approach as a defensive investor. When it comes to selecting individual stocks, Graham suggests following 7 criteria to help you make wise choices. These criteria are like a set of rules or guidelines that can help you determine if a company is worth investing in. Let's take a closer look at each criterion. Size. Graham suggests considering companies with more than $100 million in revenue. This criterion was set in 1970, and nowadays a company's size might be better represented by its market value, which could be at least $2 billion. Larger companies tend to be more stable and have a better chance of surviving difficult times. Strong financials. Graham recommends looking for companies with assets that are at least double their liabilities. This means the company should have more resources than debts. Additionally, a company's working capital, which is the money left after paying off short-term debts, should be greater than its long-term debt. This indicates that the company is in good financial health. Dividends. Look for companies that have continuously paid dividends over the last 20 years without any interruptions. Dividends are payments that companies make to their shareholders from their profits. Consistent dividend payments can be a sign of stable and reliable company. Earnings. The company should have positive earnings in each of the past 10 years. This means that the company has been making a profit consistently without any unprofitable years. Positive earnings indicate that the company is financially successful. Earnings growth. Graham suggests looking for companies with at least 33% total growth in per-share earnings over the past 10 years, which is around 3% growth annually. This criterion helps ensure that the company is not shrinking over time and has the potential for future growth. Price-to-earnings ratio. This ratio should not be more than 15 times the average earnings of the company over the past 3 years. The price-to-earnings ratio compares the price of a stock to the company's earnings. A lower ratio suggests that the stock is priced reasonably and may have room for potential growth. Price-to-book value ratio. The price-to-book value ratio should not exceed 150% of the book value or net asset value of the company. Book value is calculated by subtracting a company's total liabilities from its total assets. It represents the company's net worth. A lower price-to-book value ratio indicates that the stock may be undervalued and could potentially be a good investment. Keep in mind that these criteria are quite strict, and not all stocks will meet them. However, following these guidelines can help you identify high-quality companies with reasonable prices. It's important to conduct your own research and analysis before making any investment decisions. Remember, investing in individual stocks can be riskier compared to investing in diversified funds like index funds. It requires more time and effort to research and monitor individual companies. So make sure to consider your own abilities, goals, and risk tolerance before choosing this approach. The aggressive investor. Unlike defensive investors, aggressive investors are willing to put in serious time and effort to research and choose their investments. They want to achieve better returns than the average investor. Now, don't get confused by the word aggressive here. It doesn't mean being careless or impulsive. Aggressive investors actually need to be very careful and patient. They have to carefully evaluate the value of potential investments and wait for good opportunities. They also need to stay calm even when the market goes up and down. Expectations for the aggressive investor. So how much extra gains should an aggressive investor expect? According to Graham, They should aim for an additional 5% per year before taxes. This is the amount of return they need to justify all the hard work and research they put into their investment. Graham reminds us that it's not about getting super high returns, but rather aiming for consistent and modest returns over the long term. But here's an important thing to know. Beating the market and getting better returns than professional money managers is not easy. Most professional managers who spend all day researching and choosing stocks don't beat the overall market in the long run, even after deducting their fees. So it's important to be realistic about your expectations. Find bargain stocks. Now let's talk about finding bargain stocks. Graham's strategy for aggressive investors is to look for companies whose stock prices are lower than what they are actually worth. It's like buying something for less than its actual value. This can work because markets are made up of people, and people can be impulsive and make irrational decisions that cause the stock prices to fluctuate more than they should. When a company falls out of favor or when an entire industry becomes unpopular, its stock price may drop below what it should be. That's when it becomes a bargain. If you buy these bargain stocks, they may later recover their prices and become good investments. Graham considers a stock to be a bargain if its price is below 2/3 of its actual value. Aggressive investor criteria. To decide whether a stock is a good investment, you must do your own reasoned analysis. Here are some criteria to help aggressive investors filter through stocks. Size. There is no specific requirement for the size of the company. Aggressive investors can consider both large and small companies. However, it's important to carefully identify good companies and diversify to manage risks effectively. Financials. Look for companies with assets that are at least 1.5 times their liabilities. Additionally, the company's debt should be less than 110% of its net current assets. These factors indicate a company's financial stability and ability to meet its obligations. Dividends. Check if the company has paid dividends recently. Earnings. Consider the company's earnings over the last 12 months. Look for companies with positive earnings during this period. Earnings growth. Compare the company's earnings from the last 12 months to its earnings from 4 years ago. Price to earnings ratio. The PE ratio should not be more than 9 times the earnings from the last 12 months. Price to book value ratio. The PB ratio should not be more than 120% of the book value. Remember, these criteria are used to filter and evaluate stocks. However, it's important to note that you must still do your own reasoned analysis to decide whether a stock is a good investment. Market fluctuations and Mr. Market. The market is always changing. It goes up and down, just like a roller coaster ride. So it's important to be prepared for these changes and not let your emotions get too tied up in them. There are 2 important things you can do when the market goes up and down. First, mentally prepare yourself for these fluctuations. Sometimes, the value of your investments may go down by 30% or more. But don't worry, it's normal. Try not to let it make you feel too sad or worried. Remember that investing is a long-term game and things can change over time. The second thing you can do is watch patiently for opportunities. When the market is not doing well and everyone is selling their stocks, it might actually be a good time for you to buy some stocks at a lower price. It's like finding a really good deal at a store when something goes on sale. Sometimes the market overreacts and you can take advantage of that to make smart investments. Now, let's talk about Mr. Market. Imagine there's a person named Mr. Market who visits you every day and wants to buy or sell your investments. Sometimes he offers to buy your investments for a lot of money, and other times he wants to buy them for a very low price. But here's the thing, you don't have to listen to Mr. Market. You don't have to do what he says or let his behavior influence you. Mr. Market represents other traders who sometimes make mistakes and act irrationally. Just because they are buying or selling, it doesn't mean you have to do the same. You should make your own decisions based on what you know about the value of a business or a stock. Don't let the mistakes of others dictate how you behave. Margin of safety. Imagine you are building a bridge. You want to make sure it's strong and can support a lot of weight. So, instead of designing it to hold just 10,000 pounds, you decide to design it to hold 30,000 pounds. That way, even if something goes wrong or more weight is added, the bridge will still be safe. When it comes to investing, the The concept of margin of safety is similar. It means you want to make sure there's a cushion or extra protection in case things don't go as planned with your investment. It's like having a backup plan. Having a larger margin of safety is important because it means you don't have to be able to predict the future or be super smart to make successful investments. Even if there are market downturns or setbacks for a company, if you have a good margin of safety, your investment can still turn out well. As Warren Buffett has said, if a business is worth $1 and you can buy it for only 40 cents, something good may happen to you. In other words, by having a margin of safety and buying investments at a lower price than their true value, you increase your chances of making a profit. So, to consistently outperform the market, it's important to differentiate between investors and speculators. Investors carefully analyze companies and prioritize long-term value, while speculators focus on short-term stock price movements. Defensive investors aim for average performance and prioritize safety, while aggressive investors dedicate more time and effort to research and aim for higher returns. Both approaches require discipline, rational decision-making, and a long-term perspective. Market fluctuations are normal, and investors should prepare mentally for them while patiently looking for opportunities. Mr. Market represents the irrational behavior of other traders, and investors are advised not to let it influence their decisions. Ultimately, it's crucial to choose an investment approach that aligns with one's goals, abilities, and risk tolerance. All right, guys, that's a wrap. Thanks for watching, and don't forget to hit that subscribe button so you never miss out on our latest videos. Goodbye.